Good afternoon. I want to make a very quick video that's not really planned out or scheduled, but I had a question I believe yesterday, on SMT divergences and finding correlated asset classes or markets. So I will be going through specific examples, and I hope that in me doing so, it will be easier to find what the correlation between different asset classes are. So, first one that we're going to look at is, let's start off with the Australian dollar. So, for those that have actually paid a little bit of attention, would notice that my watch list on TradingView is sort of arranged in an alphabetical order. So I have all my Australian dollar pairs there, my Canadian dollar pairs there, Euro, GBP, NZD, and the dollar itself, with the indices following, with and then crypto and other commodities. So going back to AUD CAD, if we want to find what the Australian dollar with the CAD is correlated to, well, firstly, the importance of correlation is to be able to find, for me specifically, it's to be able to find whenever there is a crack in the correlation, whenever there is something, there's a discrepancy that should not be there in the correlation, because we know that, for example, NQ or NASDAQ 100 should be moving in one direction as the S&P 500, because they are correlated. They are sort of the same market in a way, and they are expected to move at the same direction, the same time, in the same way. But obviously the correlation is not really perfect as in one-to-one, but you sort of gauge the same, you sort of see the same price movement on them. For example, here we saw a consolidation, then a drop off sharply, then now we are retracing back to these relative equal highs up here, and we are seeing the same thing. But here we consolidated, swept liquidity to a new high, creating what I consider to be the crack in correlation. So for me, this now becomes an SMT divergence, because if they are truly one-to-one, then at this point, at the 12 o'clock mark from Thursday the 21st, we should have also taken out the same high, because that's the same high there. Notice how NASDAQ didn't take it, but S&P did it. And either way, we go back to the same crack, the same correlation. We dropped off, fell off, and now retrace. Dropped off, fell off, and now retracing. So that's basically what correlation is. We know the one of S&P 500 and NASDAQ is very clear, because we know that these are American stock indices. The difference is that the NASDAQ has 100 companies, 100 tech companies, while the S&P 500 has the top 500 companies in the US. So obviously the third one would be YM, which is the Dow Jones Industrial, but there are only 30 companies there, making it a little more volatile than the other two, and making it look a little more different than the other two, because we can see here we did not get a consolidation like we did with the other two sisters. We got a sharp drop off, a sharp rise, taking out liquidity just like E-mini S&P 500 did, and then we got the displacement downwards just like we did on the other two. So this is a little lighter and can move a little more dramatically, if you would. And the other one, which is the granddaddy, if you want to call it that, that's what I call it, is Russell, RTY, where it's basically the top 2,000 companies, and you can see the exact same, well, similar formation: chop, new high, displace, retrace now. So they are correlated when we're talking about these indices, these American indices. So if this is the case, how do we find correlation when it comes to currencies? Let's start with the simpler one, which is the dollar. With USD CAD, you might ask me, if you are not really familiar with it, what would I be comparing USD CAD with in terms of finding correlation? I would say compare it straight with the dollar index, because the dollar is the first currency in all these pairs here in USD CAD, USD Swiss, USD Yen, and USD ZAR. We have US dollar being the front currency of the pairs, so the US dollar is the one that will be driving them the most. So in other words, if the US dollar is falling off, USD CAD should be falling off, as long as the correlation is there. So we can see here we dropped off in the same way we dropped off in the dollar. The same applies to USD Swiss. We can see the dollar dropping off from the high there, and USD Swiss also dropping off. But of course, in this case, USD Swiss did not drop off as much as USD CAD did. Most probably because, yes, the dollar may be weak, but maybe the Swiss franc, for example, may be weaker than the dollar. So weak and weak would just cause a consolidation in the market, or the same way that strong and strong would just cause a consolidation in the market. They don't really pick a direction. So you could find that the Swiss franc is weaker as well, so we don't get a sharp drop off like we did on the dollar index. The same goes to USD JPY and USD ZAR, or USD against any other currency. Looking at USD ZAR, we can see the same fall off. Looking at the yen, USD JPY, we see a consolidation as well, because the yen on its own is losing strength, and I think that's visible across the board, because when you check charts like NZD JPY or GBP JPY or Euro JPY, AUD JPY, or CAD JPY, you would notice that they all run into the upside, showing you the weakness of the yen right now. So obviously, if the yen is falling off and everything against the yen is blasting off to the upside, then pairing up a weak currency like the dollar that's already weak against the yen that's also weak would not cause price to move anywhere, which is why you would find USD JPY just remaining stationary and having this messy price action, this chop. So we get a consolidation. So now that we've gone through that, I think this should allow you to know how or what pair to use for correlation's sake. But yeah, we can see, if we're talking about correlation, we can take the high that was formed here against this high that was formed here. Notice how we got a crack in the correlation at that high with this one. So the fact that USD CAD failed to make a new high while the dollar itself successfully made a new high would probably be an indication, if you're looking for lower prices, would probably be an indication for you to look for selling opportunities in the dollar index or USD CAD as a currency pair. So this could be some sort of trade idea to this outside liquidity of some sort. It's like USD CAD there. So yeah, I use it specifically for finding crack in correlation. So now going back to AUD, we have AUD CAD. Now when it comes to cross pairs, how I easily identify what pair to pair up with is by looking at the first currency in the pair. In this case, it's Australian dollar. We already know, or at least we should know, keep in mind that we have, let me actually see if I can write it out. So we have the Australian dollar, 1 second, Australian dollar operating during the Asia session, and similar interest rates with the New Zealand dollar, the same way that Euro operates during the London session and has similar interest rates as the pound, as GBP. So you find Euro correlates almost 1-to-1 to pound, while Australian dollar correlates almost 1-to-1 to New Zealand dollar. So when it comes to correlation, using this simple fact would help make it easier to dissect. So if we are looking for the correlated asset class or the correlated pair to AUD CAD, in this case it would be NZD CAD that we look for to pair it up with. And let's see if we see any sort of similarity when we do exactly that. And we can see we got a sweep down there, sweep in liquidity, and then a sharp move up, sweep in liquidity, and then a sharp move up. Of course, in this case, NZD CAD did not sharply move up the same way that AUD CAD did. So the correlation, just like we did discover in the indices, is never really going to be one-to-one. It's never really going to be perfect all the time, but it's just something to look at and use to find out when there's a crack in the correlation. For example, I know we have an SMT, a massive SMT divergence in these two pairs because I was looking at it recently. But yeah, let's see. Notice this swing low right there. The swing low was made on the 5th of February 2024, while this swing low was made on the 5th of February 2024. Notice how on this side we managed to successfully sweep the low over there, but on this side we failed to sweep the low. So this created an SMT divergence and was actually the reason I took this trade earlier in the week and got my profits hit the next day. So yeah, SMT divergence, high time frame PDRA, in this case was NZD, but I took AUD because it was the stronger of the two, and I got my confirmation on the 1 hour to take it back to the upside. But that's not the point of this video. So this is basically what I mean when I say I use these currencies for the sake of finding cracks in correlation and SMT, which is basically SMT divergences. So let's see if we can pick any random one. If we chose euro dollar, for example, I know it's basically common sense at this point, but if we chose euro dollar and we wanted to find the correlated asset or currency pair, I believe it's going to be obvious to everybody at this point that it's going to be GBP USD. And I think that's also, I think if you've been trading for some time, you would know that that's why we pay a little more attention to euro and pound whenever we're looking for cracks and correlation. So let's say the daily chart, for example. Let's go on to the daily. We'll see a very obvious shift. Notice how on GBP USD we swept these highs in this choppy area over there, while euro failed to take out the high, because this was a 60 days high, I believe, in the month of February. It was a 60 days high, so euro failed to take it, creating this SMT divergence and indicated to us that we might be going lower. So I saw this, and that's when my bias switched from being bullish to being bearish. So right now we can see, because of this SMT, there's a likelihood that price may respect this fair value gap here, which is also within the weekly fair value gap, and possibly continue lower from here. But if you're going to be looking at a daily PDRA, then obviously you'd prefer, you'd want to see a 1 hour shift in structure to confirm this entry and take it back down to the sell side liquidity, which is what I illustrated here, if you noticed in the first few seconds of the video. But that's another side thing to note. So we just did 2 random pairs. What about NZD JPY? This will be the second last one that I do. With NZD JPY, I hope you would be screaming at your screen that that's basically AUD JPY, because that's correct, because I just said now that the first currency is what we look at, and the fact that we already identify that AUD is closely related to NZD, while euro is closely related to GBP. So if we are looking at NZD JPY, our correlated pair would be AUD JPY. So like right now, we can see there's sort of an SMT divergence at the highs. Of course, this is not a swing high yet. We still need to wait for 2 other days to confirm the swing high, if it is in fact going to remain a swing high. This could be a possible SMT divergence and something that might signify lower prices. Could be, but of course we don't have a swing high, so nothing to confirm this idea yet. But you can also see that we are basically moving more or less in the same direction, in the same time, in the same fashion, like that. So we have an SMT here before we even went and took out this high. So that's basically it. But now there's a tricky question. What about a currency pair like Euro GBP, for example? Euro GBP does not have a correlated pair because we just explained now that Euro and pound are closely related when it comes to interest rates. So because they are nearly one-to-one, and remember what we said about strength in the beginning or somewhere in the first portion of this video, when we identified that USD right now is weaker, is as weak as JPY is, right? US dollar weak, the yen weak, therefore causing a consolidation in the market with USD JPY. So obviously, if we have a currency where, like in this case, in the case of Euro GBP, where Euro's interest rate is similar to GBP's interest rates, you're gonna get a collision like this: a sharp move up, sharp move down, sharp move up, sharp move down. So with pairs like Euro GBP, I don't necessarily use them for cracks in correlation. I use them to identify which one might be stronger or which one might be weaker. So in this case, we see that Euro GBP has been rallying to the upside. This might signify to me that either Euro is strong right now, or GBP is just so weak that Euro GBP ends up taking off. So right now, if I was looking for selling opportunities between EU and GU, I would obviously be looking at GU. So why would I be looking at GU? Because in this case, it seems like Euro is the stronger one, or at least GBP is the weaker one. So I'd rather just take GBP USD for selling opportunities. So if I just mentioned this now about Euro GBP, you'd obviously be realizing that the same applies to AUD NZD, because again, closely related asset markets or interest rates. So you're going to likely get a consolidation. In the case of Euro NZD right now, we don't have that consolidation that we would typically get, because this is what the typical price action looks like. We get a consolidation, a sharp drop, a sharp reversal, sharp drop, sharp reversal, and we don't really go anywhere. But it shows right now, the fact that it's rallying up shows you that AUD is stronger than NZD right now, or NZD is incredibly weaker than AUD right now, making AUD NZD just rally to the upside. So pairs like this cannot, I wouldn't really trade them or use them for the straight of identifying which currency might be weaker than the other one. The same goes with CHF JPY or JPY CHF, because the Swiss franc and the Japanese yen are both safe haven currencies, so you'd get a collision there as in a one-to-one. The other correlations that we should know about is on the crypto markets, for example, BTC against Ethereum. I feel like that's something a bit obvious, but we get those correlations as well, where they basically move more or less the same direction. Maybe not as much as the other one, but more or less in the same direction. We also obviously have interest rates and treasury bonds. So here, for example, we have US 30, which is the 30 years bond. Then we got the, here it's supposed to actually be ZB, but I'm not going to worry about changing it right now. So here, for example, we have the 5 years, the 30 years, the 10 years, and you can see that they move more or less in the same direction. When I see a crack in the correlation, that's the time I decide to pay a little more attention to the charts, by the way. And while we're here, I should also mention that the 10 years, the 5 years, and the 30 years move more or less in the same direction as the dollar index. And we can see that we've tested the 50% of this dealing range and rallied to the upside, the same on all three of them, which makes me think, which makes me believe that the dollar is still bullish and we were just trading into a discount right now for the sake of rallying to the upside later on. Because the fact that the dollar index has fallen as much as it has, while the interest rates have not fallen at all, we just retraced into this fair value gap. The same here, the same here, this tiny fair value gap here. We didn't even retrace into this one. And we're rejecting sharply from here, from these highs, from these relative equal highs. We're rejecting, well, looking to be rejecting higher. So I don't think the dollar is bearish yet, and I think we're just going to respect this bullish order block for higher prices. In any case, that's basically all there is when it comes to correlation and everything else in between. If you have any questions, or if you have specific currency pairs that you would like me to give the correlation, I'll just respond and give it to you in the comment section of this video. So for now, stay safe, good luck, and good trading.